Welcome to another edition of Focus on Alternatives, sponsored by ADISA, the Alternative and Direct Investment Securities Association. For more educational content like this, you can check out the resource library at adisa.org. My name is Geoffrey Dohrmann. I'm the CEO of Institutional Real Estate, Inc., which is the publisher of Real Asset Advisor magazine. I'm joined here today by Miguel Sosa, who's the research strategist and product specialist with Bluerock. And today, what we're going to be talking about is comparing and contrasting the features, characteristics, applications, and suitability of the most commonly used fund vehicle structures in the industry today. So, first question for you, Miguel, would be what vehicle options are available for investors interested in real assets? What are the options available?
Sure, thank you for having me, Jeff. So there's a multitude of options. Certainly, investors know that they can access real assets via public markets, but we believe that the private market or the private space offers more opportunity for investors. And there's three types of vehicles in which they can invest. The three categories would be interval funds, tender offer funds, and I'll broadly say closed-end funds or non-traded funds such as BDCs or non-traded REITs.
Okay, when you mentioned that you prefer the private markets, but haven't the public markets outperformed the private market vehicles?
So certainly public markets have performed well in the real asset space, public REITs being a perfect example, but there's always two components to investing. And returns is only one of them. Volatility and risk is the other component that investors should consider. And in that case, private vehicles or private investments offer a much more compelling and a lower volatility profile.
And so when you add a lower volatility asset to the portfolio, what is the impact on the portfolio?
So of course, a lower volatility investment will benefit the total portfolio in two ways. One is the lower volatility that it contributes to the portfolio, but also the lower correlation that most private assets have compared to public markets. If public markets sell off, say, 1%, typically, whether it's equities or public REITs, will sell off based really on public market sentiment, where private markets are a little bit more insulated.
Now, you mentioned a variety of different types of vehicles, from tender offer vehicles to BDCs to non-traded REITs to interval funds. What are the defining characteristics that separate those different categories into classes?
Sure, there's lots of different differences, but I would characterize three as being most important. The first one is the asset types. The second are redemptions and redemption windows. And the third are the valuations or the transparency for each type of vehicle. And so if I start with asset types, first and foremost focused on liquidity or less liquid assets, interval funds can invest up to 95% of their assets into illiquid investments, but other non-traded vehicles can invest 100%, so relatively small difference there. But more importantly is the direct versus indirect ability to invest. And so what I mean by that is certain structures, such as say private REITs, can invest directly into real estate property. They cannot invest into other vehicles, whereas interval funds can. The second component...
Can and do?
Can and do, correct, correct. The second component is redemptions, or redemption opportunities for redemptions. There, tender offer funds and non-traded vehicles certainly offer windows for redemptions, but those windows can change at the discretion of the board. Interval funds have fixed and mandated windows of liquidity or of redemptions that they must offer to investors. So the prospectus will state the window and the amount that investors have the ability to redeem at. So comparing to, say, a BDC or a non-traded REIT, where there is a typical redemption window, but then the board of directors changes that window. And so the dreaded gating that investors always dislike. And the last.
So why is this redemption feature so important for investors and for advisors to be aware of? Because typically when you're investing in a private equity type investment or private debt investment, you're investing for the long haul. You know that your money's going to be tied up for a period of time. You'll eventually get it back, but and get returns. But why this inner period why do you need redemptions?
Yes, that's a great point, because everybody, or most everybody, has a long-term horizon until life happens. And so for the most part, we do encourage investors to have a long-term horizon when they invest, but sometimes the unexpected occurs, and they want to have the ability to exit if that's necessary. And we think that it's important to offer that window stated in an unchanging manner versus in vehicles that may have that stated window for redemptions, but again, may change at some point over time.
And are there secondary market transaction platforms where you can trade your units out if you can't get your redemption done?
Yeah, so for some vehicles, there are secondary markets that allow an investor to sell their interest to other investors. However, the largest challenge there is that investors may experience a significant discount to their stated NAV, and so they might be able to find another investor that will take over their interest, but they may see upwards of double-digit discount to what the stated value of their investment is.
Are there any rare situations where an investor could actually liquidate through the secondary market at a premium?
There certainly are cases where they can liquidate at a premium. If market trends and market sentiment is optimistic and bullish, and the particular investor needs to sell their interest, they can certainly sell at a premium. But also secondary markets have some type of transaction cost as well. And so there's that to keep in mind.
So talk a little bit about how the interval funds work in terms of redemptions.
Sure.
Right? I mean, they have a certain breaking capacity, right, to keep from having a run in the fund to protect the investors remaining in the fund. How does that work?
Yes, that's correct. So interval funds, at the launch of the interval fund, must state what their interval window and amount will be. And that will persist through the life of the fund. So interval funds typically offer windows of quarterly, semi-annually, or annually, and in ranges of 5 to 25% of the total fund AUM. Most typically, we see that interval funds have 5% of the fund AUM offered quarterly to investors. What that means is if a fund has $1 billion in AUM, every single quarter, the fund sponsor must offer up to $50 million to all investors that wish to redeem.
And how long have these interval funds been in existence? How long of track record do they have of being able to meet redemption requests?
The structures have been around for over a decade now.
Okay.
And in terms of ability to meet redemptions, they have a very good track record of meeting redemptions as well. Certainly during the volatility that we saw in 2020, there were some interval funds that received requests above their stated threshold. Some of them met investors' requests. Others maintained at their stated thresholds. But by and large, the fund sponsor has the ability to certainly meet redemptions above and beyond the stated threshold, but that is at the discretion of the sponsor.
And how about the issue of valuation? Because when you're having to redeem, you have to redeem it at some kind of valuation. How is that managed, the whole valuation process?
Sure. So for non-traded REITs or BDCs, valuations can typically occur periodically, whether it's monthly or quarterly, versus interval funds, which are priced or valued daily. And so every day there's a NAV struck, and every day investors can subscribe into the fund. And so every day also investors know exactly the amount that they hold in terms of shares or the amount they have invested in. And so one advantage there is that there is, again, that price transparency, that investors have the confidence of knowing the daily pricing, compared to what we've seen in the past. Some non-traded vehicles will maintain a stale price for some period of time and then change, sometimes drastically, the amount that the price is valued at.
But the underlying assets aren't being valued by an independent appraiser on a daily basis. How do the fund managers come up with some kind of mechanism to allow them to translate periodic appraisals into daily valuations?
That's correct. And so that really depends on the asset class in which they're investing in. In the specific case of real estate has the benefit that there are many different metrics that are available in real estate. And so those metrics can help contribute to a modeling of pricing for these types of vehicles. So whether it's comparable assets or whether it's publicly available vehicles, there are different inputs that one can use to create a model towards that pricing. And so with that model, you can achieve a fairly accurate price of an interval fund.
We've described a lot of these different vehicles. Which vehicle do you think resonates the best with investors and why?
Sure. So they all have their pros and cons, but we believe that the interval fund fits that sweet spot of all the characteristics, some of which we've talked about. Certainly the liquidity and the stated redemption frequency is one benefit. Valuation as well, in terms of knowing what they are invested in and how much their investment is worth. But also a very important part is the regulatory regime or the structure around interval funds. And so unlike other non-traded products, interval funds are registered vehicles under the 40 Act. And so they must have daily NAV struck, they must have an independent board of directors, there's limits on leverage, and they must state every quarter their full holdings. And so these types of characteristics afford investors the advantage of knowing what they're investing in and knowing what they hold. And so we think those are characteristics that are also important for investors.
Now, I know when interval funds were first introduced to the marketplace, some advisors held back, waiting to see how the mechanism works. But you've got a decade of track record under your belts now in terms of operating these funds, not you personally, but I mean that the industry does. Are there any other concerns that some investors have, perhaps misconceptions that they hold about these investment vehicles? Or are they pretty much washed out by now, the concerns?
Most of them are washed out by now. The cases where we do see are investors or advisors not really understanding the interval fund structure or confusing interval funds with non-traded REITs. As we talked about also, not understanding the valuation every day. But for the most part, the track records speak for themselves, and the redemptions and the ability to redeem speak for themselves as well. And so as interval funds have been able to both meet objective or meet targeted returns, meet risk profiles, as well as meet repurchase requests, advisors are much more comfortable in investing in interval funds.
So we're going to close. Is there anything that you would like to say to bottom line what we've been talking about for the investment community and the advisor community out there?
We don't know what equities and fixed income markets will offer us going forward. It's more important for advisors to look at alternative asset classes such as real assets and in alternative vehicles as well to meet their stated investment objectives.
Okay, thanks Miguel for joining us with us today. And thank you all for joining us. If you're looking for more information about the merits and the pros and cons and different attributes of the various fund alternatives discussed in today's program, or if you want to just see videos from the Focus on Alternatives series, because there's plenty of them we're producing, please just visit adisa.org. Okay? And again, thanks for joining us today.